What is SME? SME stands for Small and Medium-Sized Enterprises. These businesses have fewer than 250 employees, make up to 50 million in annual turnover, or have a balance sheet total under 43 million. In Serbia, over 99% of the businesses are SME. They play a key role in creating jobs, boosting innovation, and supporting economic growth.
Alright, now I will discuss a review of the literature on capital budgeting by following this situation. In recent years, this issue has been extensively explored in the literature. For example, Graham 2001 has involved 4,440 companies and 1,352 chief financial officers, which we call CSO, is for example in the USA and the Canada. This can be obtained from the result of the survey that we significant finding was that the majority of the company in the sample used the present value of method to evaluate the future investment. But however, the emphasis of the company size as the most important factor if you see the company's investment criteria selection. The result showed that the large firm prefer to use the net present value (NPV) technique, while small firms use the payback criteria to employ the investment project. In addition, small firms also use sophisticated techniques such as VAR, which is value at risk. The cost of the capital showed that the large firms are more likely to use the CAPM, which is called Capital Asset Pricing Model, but the small firm will follow what investors tell them what they need. So in 2006, Scott targeted a similar issue using data from the National Federation of Independent Business to study the capital budgeting practices of small firms in the USA. So the results show that the large firm will rely on the discounted cash flow analysis, but small firms rely on the payback period. However, according to the survey, the main reason why small businesses do not usually rely on discounted cash flow and resist in project evaluation because of the liquidity issue and cash flow estimation challenges. So the key reason for the unusual use of the complex project evaluation approach according to the author is the limited education background of a certain firm owner and the small state size. Alright, so next I will talk about Brunei 2004. So according to the Brunei 2004 in Europe, they used a similar survey for the issues such as capital budgeting because of the capital structure and the corporate governance. The result is similar to the USA, which means that the large firm use discounted cash flow to evaluate CAEM. Besides, the small firm will also use the payback criteria and follow what the investor tell them what to do. And the last author, Endor 2011, presented this survey including the executive of the companies in Japan, in Central and Eastern Europe, which are Bulgaria, Croatia, and Eastern Republic, Hungary, Latvia, Lithuania, Poland, Romania, Slovak Republic, and Slovenia. It is showing that the size of the company had a big impact on how capital managing their procedure were implemented. Large companies and multinational firms are more inclined to use the DCM, which is discounted cash, and we said for instance NPV, net present value, and IRR method, which is called internal rate of return, and more sophisticated techniques such as sensitivity and real option, and this is unlikely smaller firm use. Additionally, less companies were more frequently using the CFM as their method of estimating the cost of equity small firm. Again, they adjusted the cost of capital to the investor in requirement. The latest survey in this country has shown a lot about how a company applying the technique they use for capital budgeting, like Serbia has been experiencing such reform for over a decade, and many learn from the best practices of the country in the region. Now I will pass to the next presenter.
Today I will explain the methodology used in our research on how small and medium sizes companies in Serbia make investment decisions. We created a questionnaire to collect information from companies. The questionnaire was based on a famous survey used in the United States and Canada by Graham and Harvey in 2001. We focused on the first part of our questionnaire, which had 10 questions about investment decisions method and how companies calculate the cost of capital. We ask companies how often they use different methods to decide if an investment project is good or not. For example, we included methods like net present value, internal rate of return, and payback period. We also ask if they have official investment policies, if they make business plans, and how they estimate future cash flows before making investment decisions. We wanted to know how they calculate the cost of capital and how often they adjust for risk in their calculation. For each method or practice, we asked respondents to rate how often they use it on a scale from 1 to 5. Here, 1 means never and 5 means always. Sending the questionnaire, we asked financial experts to review it to make sure the questions were clear. If any CFOs had trouble understanding a question, we offered to help them by phone to avoid confusion or mistakes. In summary, our methodology was used to a well-designed questionnaire. Ask the right people and make sure our questions were clear and easy to answer. This helped us get reliable information about how Serbian SMEs make investment decisions.
I will explain about the first result. The finding shows that small, medium, and micro-sized companies in Serbia mostly use the payback criteria method to evaluate investment. The data supports this. Among 7 techniques offered in the survey, the payback criteria method was used the most with an average usage of 68.8%. The profitability index PI was the second most used at 58%, and net present value NPV followed at 42%. More advanced methods like SA and IRR were used less often. Many companies mentioned that they find it difficult to calculate the discount rate, mainly because Serbia's capital market is not well developed. The payback criterion method does not require a discount rate, which makes it easier to apply. Some business owners also explain that limited financial knowledge and small team sizes make it harder to use more complex tools. That's all from me.
Let's proceed to the next part of this analysis result. From the analysis, it is confirmed that the SME company in Serbia are most inclined to determine the cost of capital. From early observation, the most preferred method implemented by the company is historical return on investment with an average value for all 3 types of the company amounting to 32%. The medium-sized company were the most inclined to use this method, which is 60% of the respondents stated that they always use this method when evaluating the cost of capital for their investment. The SME company in Serbia faced challenges in applying complex models due to inefficient capital market. Due to lack of knowledge regarding contemporary financial concepts, they make decisions cautiously because it can directly affect the finance decision regarding the acceptance or rejection of investments. That's all from me.
The study found that most Serbian SMEs still rely on simple tools. They rarely use advanced technique. It is because 2 reasons. Number 1, literacy gaps. Second, limited resources. To improve this, they need more training, support, better financial system, so that these businesses can make a better investment choices in the future.